Hello everyone, this is Kshitij. On 1st Feb 2025, Finance Bill 25 was announced in the budget. This video is regarding the direct tax amendments what is proposed in the Finance Bill, and we'll try to analyze the clause by clause all the provisions of the Finance Bill 25 in respect of direct taxation provisions. First thing, we'll discuss about the tax rates applicable for individuals like section 115 BSE. For assessment of 26-27, they have changed the slab rates. It will be applicable for individual, Hindu undivided family, association of persons, body of individual, artificial juridical persons, all these kind of SSCs except firms and companies generally. Earlier the basic exemption limit was allowed up to the limit of rupees 3 lakhs. Now they have done the nil tax rate in case of income up to 4 lakh rupees. Then in every 4 lakh increase of income they have increased the rate of tax by 5%. Like 4 lakhs to 8 lakhs it is 5%, 8 lakhs to 12 lakhs it is 10%, 12 lakhs to 16 lakhs it is 15%, like this. So above 24 lakhs it is 30%. It goes on up to that level. If any individual is a resident and his income is chargeable to 115 BSE 1A, which is the new regime, which is the default regime nowadays. So they have also increased the rebate for that person. Earlier the rebate was allowed up to 7 lakh if the income is up to 7 lakhs. Now they have increased the rebate if the income is up to 12 lakh rupees. So there is a clear-cut saving of tax of rupees 60,000 for any individual. The slab rates of 5 and 10%, tax liability will be calculated, but it will be provided as rebate. But there is a catch in this provision that 12 lakh limit for calculating rebate will be checked only for the income which is non-special rated. For example, capital gains under section 111A, 112, 112A and other special rated incomes will not be included while computing the rebate under section 87A in this case. Earlier this limit was 25,000 if you are earning total income of up to 7 lakhs. But now due to this enhancement, this limit is up to 60,000. That 60,000 rebate will be allowed to you. Now coming to the point that if you are earning marginally higher than 12 lakhs, what will be the case over there? Earlier we have seen in the new regime that if your income is up to 7,27,780 rupees, then you were getting the benefit of marginal relief, that whatever increase in tax is there, it should not increase your increase in income. Whatever tax amount you are trying to pay, it should not increase more than the amount it is exceeding 7 lakhs. Suppose 7 lakh 5,000 was your income, so you should not pay taxes more than 5,000. If the tax liability is coming more than 5,000, then whatever excess was coming, you were getting the marginal relief over there. Same thing will apply in this case also, but the income limit is increasing from 7 lakhs to 12 lakhs. So here the limit has also increased for marginal relief. It is 70,588. So if you are earning the income 12 lakhs 70,588, till that case you have to pay only 70,588. The whatever increase in your tax is there. After that your normal calculation will be there. Now one more thing is there in this one, that these are not applicable for the new regimes as we already told, and this standard deduction will be applicable. Whatever 75,000 standard deduction is there for the new regime, it is still applicable. So if any person, if you forget about the marginal relief for the time being, if any person is earning 12,75,000 as income apart from the special rated incomes, then his total income will be 12 lakhs and the 60,000 tax liability arising on 12 lakhs should be deducted, should be allowed as a rebate. Now whatever standard deduction you are taking and whatever rebate limit is there, that is after deducting your standard deduction, 12 lakh limits has to be checked. Now we'll understand this with an example. If a person is having the total income of 12 lakh rupees, 12,70,500, 12,75,88 and 12,75. 4 examples are taken over here. So what is the tax calculation according to the new slab? It is considered only up to 16 lakhs because the income limits what I have considered over here is below 16 lakhs itself. If it is more, then similarly 16 to 20 lakh 20%, and accordingly it should apply. So total tax is coming in case of income earning 12 lakhs. Total tax is coming to 60,000. And in case of similarly it is coming 75, 75, 75, 88 and 71, 250. So what is the rebate allowed over here? If you are earning anything more than 12 lakhs, no rebate is allowed. So rebate under 87A is allowed only if you are earning up to 12 lakhs. So 60,000 in the first case will be allowed fully as rebate. There is no point of marginal relief in this case. Coming to the second case, 12,70,500. Here no rebate will be provided because your income is more than 87A. But in this case, your income tax should not increase more than 70,500 because your income is increasing 70,500, and if you are asked to pay for this increase tax of 75,000, then that is unethical from the point of view of the SSC. It is a burden for the SSC basically. So the remaining amount is allowed as the marginal relief. In this case, if you see the total tax calculation is 75 over here, but my income is increasing only by 70,500. So the amount of 75 rupees which is in excess of the increase in income, tax amount in excess of the increase of income will be allowed to me as marginal relief over here. So if we see that the tax amount is restricted to the maximum amount increase in income, so marginal relief of 75 is provided. Same way, if we come to 12,75,000, then in this case your tax liability is 71,250. So that should be your maximum in this case, 71,250, because your income is increasing 75,000. So if 75,000 increase in income is there, then you can pay taxes up to 75,000 rupees. But your liability is 71,250. So you have to pay the full amount as tax, and no marginal relief will be available. And as we know, income is more than 12 lakhs, so 87A debate will also be not applicable to you. Now coming to the last case, just calculating the limits, 12,75,88. Here what is happening, your tax liability is 75,88. You won't get any debate, but marginal relief, you are getting the tax amount also as the 75,88. So this is the case, this is the break even point where your increase in income is equal to your tax amount. If you earn anything more than this, then you will come under the normal tax calculation, and if you are earning anything up to this amount, then you have to check whether your tax amount or the marginal relief you have to calculate, and you have to see that your tax amount should not increase your increase in income. So these are the cases. It is not allowed to special tax rates. And coming to the second point now, International Financial Service Center. There are various benefits given to IFSC in earlier years, in the earlier budgets. So in order to promote the IFSC for doing the businesses in India, now they have made some amendments, that concessions, they have provided some concessions to the IFSCs. Seeing the development of the IFSCs, they have provided some more amendments. They have proposed to provide some more amendments to the IFSCs. What are these? Total of 6 points are there. Actually, they have provided 6 exemptions over here. If you can see here, total of 6 points are there. We'll try to understand this from the analysis done below. It is the same thing. There are certain tax concessions allowed to IFSCs, that if they are investing amounts up to this date, then they are provided some exemptions under section 80LA, under section 104D, under section 104F, under section 104S. Like these sections, they were getting some exemptions. So they were getting some exemptions over here. So what was the case over here, that these exemptions have been extended to 2030, 31st March 2030. These exemptions have been extended, and they can claim this benefit, tax concession benefit. If they are doing the business in IFSC, then they can start operations up to 2030. If they are starting the operations up to 31st March 2030, then they can claim the concessional rates applicable to IFSCs. This is the first benefit given to the IFSCs. Coming to the second point, life insurance policies. Life insurance policies, unit-linked insurance policies or life insurance policies, having the benefit. In the global world, it happens whenever a unit in IFSC is providing any insurance services, we know that IFSC unit or IFSC business service providers are treated as a foreign company for us, foreign company or non-resident associates for us. So what is the case over here? If a non-resident associate is going to in some foreign country and he is doing the business of life insurance over there, then he can claim the full amount as exemption over there. But in India, what happens? And after the introduction of clause 10D of section 10, the amount of 2.5 lakhs in aggregate or in single premium in case of ULIP, unit-linked insurance premium, and in case of life insurance policies, it is 5 lakh limit. If premium is more than that, then you are not getting any exemption over there. But these IFSCs were facing compliance difficulties. They were facing difficulties of the benefit over there in comparison with the foreign jurisdictional areas. So what is done? These limits of 2.5 lakhs and 5 lakhs limit is removed for them. Now they can claim, if they are into the business of life insurance policies, they can claim the exemption. They can claim the exemption directly, even if the premium amount is more than 2.5 lakhs, or for life insurance it is more than 5 lakhs also. Without any condition, they can claim the benefit over here. Now coming to part C, point C, what does it say? Some capital gain exemption is also provided to IFSC units. Earlier, what was the case in earlier budget, it was announced that aircraft leasing business, any IFSC unit involved in the aircraft leasing business will get some exemptions over here. Two sections are there, subsection 4H of 10 and clause 34B of section 10. So it was allowed to non-residents in case of transfer of equity shares of domestic companies. Like if any domestic company is having a unit in IFSC and that company is engaged in ship leasing. Suppose a ship leasing business is there. If a non-resident is there and they are into the business of ship leasing activities, ship leasing business is there, and they are the domestic companies sitting in the IFSC. Then and the second company, let's take the example. There is a company A. Company A is a IFSC registered or a non-resident registered in IFSC, and they are into the business of ship leasing, and they transfer the shares of the domestic company which is also IFSC and engaged in shipping business. So if one shipping business inside the IFSC, not inside the IFSC or non-resident, is selling the shares of other domestic company in the IFSC, then it is exempt. That then it was exempt from the capital gain under clause 4H of section 10. Now this has been extended to, earlier this was extended only to aircraft leasing business. Now it is extended to ship leasing business also. Same way in for the dividends, whatever dividend is paid by such companies in between these two companies from the company whose shares has been transferred, if the company is paying some dividend, in the same nature of company is paying some dividend to the company engaged in shipping business, then under clause 34B of section 10, that is also exempt now. So this two exemption is provided in line with the aircraft leasing business to the ship leasing businesses. Now coming to the fourth amendment done for the IFSC, that definition of dividend is changed for treasury centers. Suppose IFSC, a company is setting up a treasury center. This we'll understand from the exam, this one analysis. An amendment has been proposed to amend the definition of dividend. So definition of dividend is amended over here in respect of the intergroup loan, intercompany loan or transaction, advance or loan transactions. What has happened that in the IFSC, if any finance unit is set up by a global treasury unit in the IFSC, if any global treasury unit is there who is having the business of giving money on advances and loan in the nature of advances and loan, they have set up a unit in the IFSC. Then advance or loan transaction of the parent entity, suppose a parent entity is there which is listed on a recognized stock exchange in a country which may be notified by the CBDT from time to time. So it is not notified till now, but it can be notified later by the CBDT, because now it is only bill. Once we see the Act 2025, then we may see some notifications over there. So if an intercompany transaction is there, that is also exempted for the IFSCs. Now coming to the fifth point, this point is related to the fund managers. What is happening over here? This also we'll see from the analysis directly. You can read the point E also above. There are two kind of things: eligible fund managers and the eligible funds. If any eligible fund manager is located in IFSC and he is commencing his operations up to 31st March 2024 and is providing any services, then it should not constitute business connection in India. But there was a condition over there that eligible fund, the fund should be eligible and not more than 5% should be held by the Indian residents in that eligible fund. So in that case, if the fund manager is providing, if any fund is having Indian resident holders up to 5% and that fund manager is providing the service of his services, so it should not constitute business connection and it will not be taxed in India. Now what is the case? They have extended this limit to 31st March 2030. 6 years extension has been provided that if eligible fund manager is starting its operation by 31st March 2030, then he should be eligible for claiming this exemption. Now coming to the point that how 5% will be checked over here. It will be checked on the balance on 1st April and 1st October of the previous year in which the transaction is happening. Suppose the transaction is happening in the year financial year 26-27. Then we'll check the balance. A limit will be checked as on 1st April and 1st October. We'll check the limits as on that date. This is the amendment brought over here. It is the same thing mentioned over here, that section 9A has been rationalized and eligible investments. If the investment is eligible, those definitions are not changed. So accordingly, this is the point. And coming to the point number F, inclusion of retail schemes and exchange traded funds. So two kind of schemes are the retail scheme and exchange traded funds. The relocation of the resultant fund, whatever fund was there in the IFSC. Suppose a business unit was there, was having the funds in non-IFSC places, and now they have transferred it to IFSC. So earlier it was not considered as transfer under section 47, clause 47AD. So now they have extended it. They have extended this scope to the retail schemes and the exchange traded funds, that these will also be not considered as transfer. If they are also relocated to IFSCs, that will not be considered as transfer. This was not there earlier. So these are the 6 major amendments brought in for the IFSCs. Now coming to the applicable dates for these provisions. Generally all the provisions are applicable from 1st April 2025. If anything specifically is not mentioned over there. So for IFSC all the provisions are applicable, like as you can see here, There were 4 such amendments in these clauses. Is effective from 1st April 2025. But this point, the relocation of exchange traded funds and retail schemes to IFSC is not treated as a transfer. This is changing from 1st April 2026. So this will be applicable for assessment 26-27. Why this is like this? Like two kinds of amendments are there. One is the transaction specific amendment. One is the general amendment. General amendment is applicable in all the things. Like it doesn't matter when the transaction is happening. So all the other cases, transaction specific date is required. Like fund investment is there, eligible fund manager is there. Obviously the definition of dividend, when the dividend is paid. But here what is the case in point number F, that exchange traded funds and retail schemes are not transaction specific. If any transaction has happened during the year at any point of time, then in the assessment while calculating it is allowed as exemption over here. Now coming to non-residents itself, there is some exemption in section 10 provided to the non-residents. In case of non-residents, in respect of the derivative transactions by the non-resident, some exemption is provided. Earlier what used to happen, in case of transfer of non-deliverable forward contracts, offshore derivative instruments, over-the-counter derivatives, and offshore derivative instrument income distribution. These are the 4 cases. If these transactions are entered into with any offshore banking unit of IFSC, which IFSCs are referred in 80LA, section 80LA, it should not be included as total income of the non-resident. If a non-resident is taking any transaction of non-deliverable forward contracts, offshore derivative instrument, over-the-counter derivative, or distribution of income of offshore derivative instruments, then whatever income he is earning from that transfer, if that transaction is with offshore banking unit of IFSC, it was not treated as income at all for the non-residents. Now this scope has been extended, that any foreign portfolio investors, if it is situated in IFSC unit, if it is not situated in non-IFSC unit, this section won't be applicable, this exemption won't be applicable. But if it is situated in IFSC, and it is a foreign portfolio investor, then in that case they can claim the same exemption in the same kind of income, non-deliverable forward contract, offshore derivative units, whatever transactions they are doing in these nature, they can claim the exemption over here. They have been provided the exemption, and these transactions should be from 1st April 26, like assessment of 26-27, whatever transactions that are happening in the financial year 25-26, it should be applicable. Now coming to 2 more kind of funds. The next point, the point number D, extension of date of making investment by the sovereign wealth funds and pension funds. These are 2 kinds of funds which are investing. These are also non-residents which are investing in India. So some exemption is provided under section 10(23) FE of that is for exemption to specified person from the income in the nature of dividend, interest, and long-term capital gains they are earning. Then from if they are making any investment in India and they are earning dividend, interest, or long-term gain, then subject to some condition they are having the exemption if they fulfill the condition as mentioned by the central government in the notification. Now currently what is the case, that it is applicable, 10(23) FE is applicable. Investment is made between on or after 1st of April 2020 but before 31st March 25. So any transaction, any investment made between April 2020 to 31st March 2025, this provision was applicable for them. Now coming to this provision, what was happening because of this, there was an amendment in section 50AA. 50AA says about the market linked debentures, unlisted debt securities. So it was told that 50AA says that unlisted debt securities under the market linked debentures, if it is transferred even after a period, even after the extension of the period of holding of 24 months, even after that, even beyond that, then it should be treated as short term capital gain irrespective of the period of holding. Now this irrespective of the period of holding, this 50AA was leading to, this will result in the long term capital gain from investment in unlisted debt investment to be taxable in the hands of these 2 funds, sovereign wealth funds and the pension funds. So before this amendment in section 50AA, it should be taxable as short term capital gain. Earlier it was exempt for these kind of people. They were not given any exemption in section 50AA. So in these cases they were supposed to pay the taxes on this income, treating it as short term capital gain because of the section 50AA, because no exemption was provided to them. Earlier they were getting the exemption in the clause 23 FE of section 10. Now they have amended the clause 23 FE of section 10 that whatever long term capital gain is being earned by these kind of people, whether it is a long term or short term, whether it is a short term normally whether it is a long term deemed to be short term under section 50AA. They cannot show it as long term. So only these two cases can be there. Either it can be short term normally or it can be deemed as short term under section 50AA. From any investment made in India, then this should not be included in the total income of the person. Same old exemption, whatever was available to them, will be applied to them now also, but the time limit for for making investment in India was earlier 31st March 2025 if they are making the investment up to that date. Now this date has been extended to 31st March 2030. So if suppose if a pension fund was there who has invested in India in 2021 after 1st April 2020 and is investing up to 31st March 2030, the full 9-year, 10-year period, if the investment is done in any point of time during this 10-year period, they can claim the exemption of this section over here. This will be applied from 1st April 2025, so it is applicable from the financial year 25, any investment made in the financial year 25-26. Now coming to electronics manufacturing facilities, seeing the electronics sector booming up, the government has provided a presumptive taxation to the electronic manufacturing industry. What they have done, in the case of non-residents, they have provided this benefit that non-residents should come to India and do the business over here. So they are planning make in India electronic system manufacturing industry, setting up of electronic system manufacturing industry in India. It is proposed to provide presumptive taxation regime to non-residents who are engaged in the business of providing services or technology to resident company. So if whatever non-residents are there, if they are providing any service or technologies in respect of the electronic system to any resident company, Indian resident company, and that Indian resident company should be in the operation of electronics manufacturing facility or any connected facility that will be notified. Ministry of Economics and Information will notify that in respect and by wide notification by the central government. So they have introduced presumptive taxation for them. A new section 44 BBD will be introduced, and whatever they are making the payment to non-residents, whatever income non-resident is earning from this kind of business, 25% of the income should be treated as the business income for the non-residents in India. This will apply from 1st April 2026 and will apply accordingly for 26-27. So basically in financial year 25-26, whatever transactions are happening, it will apply for those transactions. Now coming to the next amendment, tonnage taxation scheme. Earlier tonnage taxation scheme was applicable only in case of sea-going ships. Whatever ships was going into the sea, it was applicable for those. Now this same tonnage taxation benefit of section 115V series has been extended to the inland vessels also. Like it was done because representations were received to extend the tonnage taxation scheme to inland vessels to promote inland water transport industry. So in order to promote the inland water transportation industry, they have provided the same exemption of tonnage taxation of 15 net tonnage, qualifying ship, qualifying income. They have provided the same benefit to inland ships. So inland for the development of water transportation industry inland. This is also applicable from the 1st April 2026 and it will apply from assessment 26-27. Now coming to the other point, charitable trust. Charitable trust can see 4 major amendments over here in the charitable trust provisions. These are the basic provisions. Before this, we will understand what is a charitable trust and how does it operate. Basically, how does it operate? That section 12AB is there. Charitable trust is income of any trust. Income of any trust or institution registered under 12AB. Charitable trust or institution has to take registration under section 12AB. If it is fulfilling some conditions, then their income is exempt. And section 12A provides for the procedure to make application, like whatever registration they have to make in order to claim section 11 and 12. So if a charitable trust is registered under section 12AB, they can claim the exemptions under section 11 and 12. But in order to claim this exemption or to take the registration under 12AB, they have to follow the procedure to get themselves registered, and that procedure is mentioned in section 12A. And there are some provisions related to the cancellation of registrations also, approval of registration also. Full process regarding registration is mentioned in section 12A. Now coming to the points, how it is done, what are the changes brought in. So first thing is subsection 4 of section 12AB, that when registration or provisional registration, two kinds of registration are there, provisional registration or registration. One provision is there currently in subsection 4 of 12AB that if any trust or institution has been provided registration or provisional registration, and the principal commissioner or commissioner, not any other officer, they have noticed that one or more specified violation has taken place during the previous year, then they can pass an order and they can cancel the registration of the trust if any of the violations have taken place. This was happening even in minor defaults, where it was not in the control of the trust or where it can be rectified. Minor default is there, not much default, major default is not there. In that case it has also happened, and the government has received some recommendations, that representations, that this should not be done. It is creating hardship for the people. So now they have amended that provide that the situations where the application for registration of trust or institution is not complete shall not be treated as specified violation for the purpose of this subsection. So what they are saying, it should not violate directly. The direct violation of registration is not applicable now in case of in case of the trusts. Whatever trusts are there, it is not applicable. And these two amendments what we saw just now is applicable from 1st April 2025. That whatever simplification was the earlier one, second one was the cancellation of registration, that relief is given, that in case of minor defaults it won't be, the cancellation of registration won't happen by the principal commissioner or commissioner of income tax. Now coming to the next part, period of registration for small trust or institution. What are smaller trusts and institutions? If any trust who is registered under section 12 is having the income, total income of up to 5 crores in the last 2 years, in the preceding 2 years, in the year in which it is planning to take the registration. For example, a trust has applied for registration in the year 25-26 and it has total income before giving the effect to section 11 and 12. So whatever exemptions are there, before taking those exemptions, if the trust is having income of up to 5 crores in the both of the preceding financial years, then like in years 24 and 25, in the given case it is given that 25-26 assessment financial year the trust is planning for registration, but its income is given 4.6 in financial year 24-25 and 5.2 in 23-24. So in the preceding 2 years its income is exceeding 5 crores in 1 year. This trust cannot be called as a smaller trust. They cannot claim the benefit over here. What is the benefit? We'll see now. So since the total income exceeds in the year, the trust cannot take the benefit of extension of validity of registration. So what is the validity of registration provided? Two kinds of registrations are there. In case of normal registration, 5 years validity is there, and in case of provisional registration, 3 years validity is there. Provisional registration is same as it is for the time being, but the 5-year time period for the trust for registration has been extended to 10 years. That their whatever trust, smaller trust is there, they can, once they take the registration, it is valid for a period of 10 years now from now onwards. It will apply from 1st April 2025. So in this case, the given case 4.6 crores and 5.2 crores, this trust is not called as a smaller trust because its income is not up to limit of 5 crore rupees in both the preceding financial years. So it cannot claim the benefit, and whatever registration this kind of firm takes, it is valid only up to 5 years. Suppose this 5.2 was 4.6 itself or any other amount below 5 crores, then this trust can claim the benefit over here of having the registration of 10 years in one shot, and it don't have to take the registration in every 5 years. Now it has to take registration in every 10 years. This is the provision over here. Now coming to the next provision in section 13 subsection 3 for trust and institutions. Whatever investments were done by the trust or institution, by any person to any trust or institution, those investments were earlier have to be deported to the trust or institution. They have to be deported. What kind of persons were supposed to deport? Suppose 3 kind of persons are there. If they are making any investment to the trust, it should be deported. That certificate has to be filed. Details has to be furnished and certificate has to be filed for that purpose. Who are the 3 kind of persons? Any person who is making the substantial contribution. Substantial contribution means any amount exceeding 50,000 rupees. Any relative of such person, and any concern in which such person is having substantial interest. So these 3 kind of persons, if they are making any contribution to the trust in excess of rupees 50,000, it should be furnished by the trust. The trust are finding it difficult to provide these details because there might be some outsider contributors also over there. So founders, authors, trustees, managers, these 4 kind of person, like who are directly involved with the trust, if they are investing, if their relative is investing, if they are concerned, if they are having the substantial interest is investing in the trust in excess of 50,000, trust can provide the details. But what about the outsiders? So government has provided some relief. They have proposed to provide the relief to this clause. Now this clause 13.3, section 13 subsection 3 clause B has been amended. This clause has been removed, that requirement to furnish the details has been removed from the relatives and concerns where the person is having the substantial interest. Now, who are the persons? Now, the definition of person is also changed. Now, the 50,000 limit has been increased to 1 lakh or in aggregate 10 lakh rupees. Suppose a person is there, he is an outsider, he is not the author or anyone. He is contributing rupees 70,000 to the firm, and his relatives are investing 1 lakh rupees to the firm. Now, the firm to the trust. Now, the trust does not have to furnish the details about the relative, and the trust has to disclose the details about the other contributor if the amount is more than 1 lakh rupees, or in aggregate it is more than 10 lakh rupees during the financial year. Suppose the same person is there, he is contributing 1 lakh every month for the full year, so it is 12 lakhs in aggregate, or it is less than 1 lakh, 99,000 he is contributing every year, so it is again more than 10 lakhs in 1 year period. So he has to, the trust has to give the details of that person. They cannot claim the benefit that it is not exceeding 1 lakh in any of the cases, any of the contributions made. But in aggregate, if it is more than 10 lakh, then it has to be reported. But in case of relatives and concerns having substantial interest, it is not applicable now, and those details are not required to be furnished by the trust. This aggregate limit of 10 lakh was not applicable earlier, and the old limit of transaction wise limit of 50,000 has been increased to 1 lakh. This is applicable from 1st April 2025, and whatever transactions are happening from 1st April 25, it should be applicable because it is a transaction wise amendment over here.